It's another data point that, again, I said it last week. I'll go out on a limb and predict my equivalent November fall predictions. Last fall, it was that the markets were going to poop the bed. My prediction now is that I think the markets are bottoming and consolidating.
Yep. 100%.
And this is the time, I think, to start nibbling and start getting ready to really rip the money in. And I think there's enough signals every day that kind of like tell me at least that on the margin, it's time, because I think the markets do a reasonably good job of digesting news and then pricing the forward reality, right? Like today's price is really everything we already know. And so the real guess is what's about to happen in the future. And from my perspective, I'm actually pretty starting to get a little constructive here. I think that when companies like Facebook really do this, and again, it's yet another indication to me that I think broadly speaking, the markets are now starting to stabilize. All the irrational behavior is starting to exit the system. The party is in the last few hours. Volume's going down, the alcohol's being taken away, people are hanging around with a little bit, lights are coming on, they're like, oh, I've been here a little too long. And I think that that's a very healthy process for an economy. And I think that that's what's happening right now. So I'm constructive, I'm a little bullish, I'll go out on a limb. I think, we could be 3 to 5% from the lows, but we're more near the lows than the highs.
Unlike Chamath, I'm having a hard time finding a silver lining right now. Part of it is the comments that Druckenmiller just made, and he's been right about this stuff. We've been talking about his predictions for over a year on this podcast. And
he famously shorted the pound for George Soros.
That was when he was first getting started. But yeah, since then, he's one of the most successful macro traders in the world and universally respected, and I think deservedly so. Remember, he said that this was in mid-2021. He said that the Fed was engaged in a radical monetary policy because even though we were starting to get inflation, it was around 5% then, that they were still engaged in this bond buying program. They're still bought like 160 billion of bonds. And he is the first one waving the alarm bell saying, what are they doing? Now his predictions have come true. I mean, we're in an inflationary spiral. And his prediction now is, his central outlook is that the Dow Jones will be in the same place where it is today in 10 years. And he made the point that, yes, equity markets do go up in the long term, but how long term are you talking about? From roughly 1966 to 1982, the stock market was sideways.
Japan had a lost decade as well. Like, this is not unprecedented.
Right.
After an asset bubble.
Right. And then from the Great Depression, it took until 1955 for the stock market to recover. So in the long run, the stock market will go up, but it could be, we could have a flat decade. This is his prediction, right? But he's a very smart guy. And then on top of that, that's not to say that you can't be one of the ones who make money during that period, because lots of people do. But we're in for, I think, a very tough economic period because of just this radical expansionary fiscal and monetary policy we've had. Basically, the Fed and the administration printed, the last two administrations, but especially this one, printed $10 trillion. We had Biden basically kept digging this hole. We had the $2 trillion of American Rescue Plan, which we didn't need. We just had another $2 trillion of the infrastructure bill, the Inflation Reduction Act.
$500 billion for student debt.
Yeah, exactly. So Jason, what are you talking about? And this was all after the emergency was over.
But I think that you guys are debating the wrong thing. I think that what Druckenmiller, by the way, just to be clear, both Druckenmiller and I can be right, which is he's commenting on the real world economy going into a recession. What I'm saying is that the stock market tends to be 9 to 12 months ahead of where we are. Nick, throw up that chart, please, that I asked you guys to share, just to give you guys a sense of what I mean by this.
By the way, while you're doing that, Chamath, Jason, look, I will agree with you that a lot of the stimulus...
I'm just pulling it up. He did 7.8 trillion.
Listen,
so he's done more than Biden, but fine.
A lot of the stimulus happened under Trump, you're right, because that's when basically COVID happened. Yeah. Remember, in that Q2 of 2020 quarter, the economy shrank at a 30% annualized rate. Everyone thought we were going into a Great Depression. And that's why they passed all the stimulus by huge bipartisan margins. And I think we can definitely go back and second guess what happened during the Trump administration. There's an old saying that many of the worst ideas are bipartisan. And so, the spending that happened in 2020 was clearly bipartisan, and maybe it went way too far. But in the last 2 years, like Druck said, it was post-vaccine, post-emergency, and they kept spending. And it's not just the administration, it was the bond buying program of the Fed, where the economy was already fully back, and they bought another 160 billion of bonds.
Yeah, I think the thing is that, I think Stan is a proven Republican, so maybe he is speaking a little bit of his book as well. I think it's fair to say that both Trump and Biden did not help, but overwhelmingly, I think where the problem stands is a central bank that was the same through both of those administrations. And I think we should probably focus on them because you're right, what they did was excessive. And what they essentially said is that if there is volatility beyond a certain amount and people cry uncle, we will not allow the markets to sort themselves out in an orderly way. We will step in. And that's what, again, what we just talked about, the central bank put, in this case, the Fed
interventions. Yeah.
And these interventions really pervert a market because you don't know what's going on. And that has huge ramifications in the real economy. So, Nick, if you could just throw up this chart, the thing that is really important here, and what this chart shows, is essentially all of the hiking cycles that we've gone through since 1983. So 83, 87, 80, 94, 99, 04, 15, and the current one. And here's what I just want to call out for you guys. What's incredible is that other than the one in 83, so this is sort of like, that last big one, what we've seen is that the stock market has a tendency to immediately go to the conclusion very early on in a rate hiking cycle. And now, why is that important for normal folks listening to this thing? Well, the reason why that's important is right now we're in month 7 of a cycle. We obviously don't know how long it's going to be, but the odds are improving every day that we're near the end versus the beginning. And why that's important is, again, if you're thinking about when to buy equities, for example, this is a really instructive guide because what it tells you is the closer we get to the end, or more importantly, the closer we psychologically know that the end is coming, we start buying. And that's just a broad-based statement that has been true. So, what you see right now, I think, is really interesting, which is that despite all the bad information, oh my gosh, the Nord Stream pipeline blew up. Could it have been sabotage? Was it the CIA? Was it the Russians? Oh my gosh, big tech is slowing spending and firing people.
China's in a coup. I don't know if you saw that rumor. Yeah.
How about something more benign? The US, US yuan is really trading in a crazy way. The US euro is trading in a crazy way. The US pound is going crazy. Yeah. Despite all of that, every time we trade down, the market consolidates very quickly. And we sort of so I think we're forming a bottom. I do think that Stan is right. We are going to see a hard landing recession. Something will break in 2023. I hope it doesn't. I hope it doesn't affect a lot of normal people, but it's likely. But at the same time,
what do we define hard landing as?
So I'll tell you in a second. But at the same time, I think what's happening is in the equity and financial markets, we are consolidating a bottom because we're seeing through to that end state. And this is where cheap equity gets bought. So why is there a reason to sell now? I think a lot of the people that are selling, the smart money sellers that I talk to, are essentially right now selling to book in capital losses to offset other capital gains from this year, a term that's called tax loss harvesting. And so if you have gains through this year, which some of us do, this is the great moment to just sell the losers, to book the loss, to net it out so that you can minimize your taxes for next year. That's probably, I think, where we are at. And I think that's why they're still consolidated.